Our next topic or theme for today will be analyzing Japanese yen economy and concurrently the Japanese yen currency. Now let's start. So when we analyze a country, of course, you already know what do we look at. We look at GDP as one of the indicators. So we look at GDP growth rate year over year, right? So looking at GDP, you could argue that Japanese yen actually, Japan as an economy is somewhat growing compared to the last few quarters in 2018, 2017. Grew the most in 2021 because of expansionary policies around the world. And that I will explain it in more detail when we compare imports versus exports. But then it has slowed down in the last 2 quarters. So what you could argue is that in the last 2 quarters, Japan economy had somewhat of a slowing down, but that is nothing significant, okay? Especially when we look at the Q2 of 2024, you have growth of 0.7%. So you see how Japan's economy in the last few years went from growing to slowing down, growing, slowing down, growing, possibly another slowing down. But this is the problem Japan economy has for the last 30, 40 years. Since they had this huge recession, huge economic crisis in 1980s, which actually caused their economy to slump significantly from that time, 1980s, 1990s, up until this moment. And these problems were followed by strong deflation. So they had prices falling down, which is something no economy wants. Now, some economists argue this deflation is caused by spending habits of Japanese citizens. But of course, there are a lot of theories why something in that deflationary environment is happening. So what we look at when we look at Japan, you had negative 2 quarters and then last quarter was positive. So could we expect positive growth if we look at the world economy, US economy, if we see expanding Chinese economy, right? You could argue that their expansionary economies could lift up Japan. The reason is because US, for example, is the main importer of Japanese products. So one of the important factors you already know is looking at GDP, looking how much the country has produced in a certain amount of time, in a certain amount of period. This is the most important measure of strength of the economy. Now, if you want to look at how their citizens live, for example, you could look at GDP per capita. So how much of this GDP goes per one citizen? It is not the same if you have GDP of 20,000, let's say, and 40,000 people in a country which produce 20,000, or if you have 20,000 produced by 5,000 people. The country that has higher GDP per capita is usually richer, right? We could even explore it. Looking at GDP per capita. So looking at all of this, you see how countries with higher GDP per capita, this is where it is written, are usually United States, Canada, Japan, you see, the whole Euro area, while the lower GDP per capita is already in South America, in Africa, you see, and Australia is pretty good. So you could argue that GDP per capita is really good. Now, is this enough to tell you if we want to go into further detail? Are the citizens living good? In this, let's say, 20,000 country, for that was given as an example, 20,000 GDP country, if you have 4,000 people that produce 20,000 goods, values of goods per year, which is a measure of GDP, you could say that how much of these 4,000 people are actually rich and how much are poor. And is there a huge discrepancy between countries? Between, no, sorry, not between countries, within a society of one country. It might happen that out of these 4 people, 3,000 people, right, are producing 18,000 values of goods of GDP, while 1,000 is producing way less. And then we come into even more detailed view, and it's called Gini coefficient, which tells you income inequality. It is written best here because the wealth, how is wealth dispersed within a country? And this is what Gini coefficient tells you. So if we were gonna go even in more detail to understand the equality or inequality within one country, which may even be rich, we use usually one of the measures we use is Gini coefficient, and you can see that we have higher Gini coefficient in African countries, right, and lower Gini coefficient in some Eurozone areas. For example, look at Scandinavia. The lowest Gini coefficient, meaning there is lower dispersion, lower divergence between rich and the poor. And in our case, Japan has lower Gini coefficient. One interesting fact is look at United States. United States has high Gini coefficient, which is, I think, apparent to all of us who are not from Europe and who have maybe visited USA in some period of time. I remember my friend was in Los Angeles and he told me there are a lot of homeless people who actually do have a job, who live in these shelters by the street. So you will not find something like that, for example, in Finland or in Switzerland, or you are less likely to find it in Japan. So you see how from big picture GDP, we went to GDP per capita. And then within that society that produces high GDP, like let's use the example of the United States, we want to see how is dispersed this GDP per capita, and this is Gini coefficient, which tells us whether we have huge discrepancy between rich and poor. The higher the discrepancy usually leads to, this is actually economic instability, because very few earn a lot, right? And a lot of people are middle or below income or below average income, which then leads to usually from economic instability to political instability. And this is why it's important to understand all of this. Japan, in our case, is a country with lower Gini coefficient, Australia as well. So there is less divergence between rich and the poor in Japan compared to the United States. So we covered and explained the measure of GDP and how GDP is used to analyze a country. Next on, we have CPI. Now let's check out CPI in Japan. Now, inflation rate in Japan, if you look at it, just a second. Inflation rate in Japan until 2021 was pretty stagnant or low. If you know that Japan's central bank policy is to have 2% inflation, they did not achieve it from 2016 to 2021 until we had this inflationary wave. Now, why is that the problem? The lower the inflation, or deflation, might actually have significant problems in causing economic contraction, falling GDP. And you can actually combine the two. Throughout history, Japan, for the last 30, 40 years, had low inflation, or that so-called deflationary environment. Prices were falling. If you want to read it, you actually have it all explained here. And then that led to low growth in GDP. And that is the problem. So until 2021, Japan had problems with deflation, and then prices started to rise. Remember, Japan did not increase the interest rate. And our main idea, year and a half ago, was to play longs on GBP Japanese yen. Mars, you can maybe even show that seminar. I think it was the first seminar where we predicted GJ longs. So while Bank of England was fighting inflation, Japan wasn't. And why it wasn't? Because actually, secretly, they wanted inflation. Because they couldn't defeat deflationary environment, falling CPI, falling prices for the last 30 years. And last politician who introduced another stimulus by monetary policy was Shinzo Abe. He was assassinated year and a half ago, I think. And his economics was called, if you want to read about it, is called Abenomics by this guy, politician Shinzo Abe. He was assassinated in 2022. So now we know what, and we knew and we know and we understood how to predict Bank of Japan's movement in this case because we knew that they actually wanted inflation, even though they couldn't say it. Because if they said they wanted inflation, this wouldn't be 4% but 8%, or because they would affect market expectations. Then everybody would short Japanese yen even more, and then they would possibly have even problems with higher inflation. Now, they did not fight inflation from monetary policy perspective. Remember, they had negative interest rates, and that led to Japanese yen weakening, and we had this. This was our opportunity in trading. This is a weekly chart, or yeah, this is weekly chart. Look at this downtrend, and we played this downtrend for the whole year, for the whole last year, and up until August, September of this year and a half of trend market movement. Now this CPI has stagnated and then started to fall. Now, at the beginning of the year, Bank of Japan said, okay, let's start slowly raising interest rates because we don't like this strong weakness in Japanese yen. And that translates itself to slowly raising interest rates and then starting to reduce the inflation. So Bank of Japan has shifted their monetary policy, but started to do it slowly towards increasing the interest rate, reducing our carry trade. You remember, because we have positive swap, reducing our carry trade, and then trying to push the inflation lower. Now, this is Bank of Japan's website, and here is actually their monetary policy meeting on January 2022. 2023. I will not go through detail. We also have it, just a second. We also have it last monetary policy meeting. In the last monetary policy meeting, September, just a second. This one is more important because it's the latest. In their monetary policy meeting, they told you that they want to achieve 1% long-term interest rate, and that they will probably achieve it in the next 6 months. Okay? So it is important to understand because they want inflation of around 2% and their interest rate, they want it around 1%. What does that tell you? That tells you that currently, if we have their current interest rate of around 0.25%, that will probably increase to 1% through time. Of course, they will follow the future macroeconomic data, future economic environment that comes to Japan, and then they will decide whether on employment, unemployment rate, CPI, just like all the others, they will look at whether they will increase or decrease the interest rate. One important thing that is different between Bank of Japan and United States is that they are following the situation in the US economy. And it makes sense because Japan's main trading partner, is actually United States. you see here, it seems that if economic activity and prices remain on track, and they are pleased, I have read all of this, so you don't have to read it. They are pleased with their economic development. They expect future, actually, quarter-over-quarter GDP growth. But they are telling you, we need to follow the situation in the United States. Our GDP is moving as we expect. And if that happens, we are going to follow our economic path, which it raises policy interest rate gradually so that the rate will be 1% in the second half of fiscal 2025 year. So we can expect that this interest rate will go to 1%. Now think about it this way. They will increase the interest rate to 1%, which will push inflation most likely lower, especially if we are now in an environment where inflation is falling down throughout the world. So they will increase the interest rate. If they will increase the interest rate, the market expects 1% interest rate in the half of the fiscal year of 2025. That tells you that Japanese yen should strengthen in next 6 to 8 months, possibly. Okay? So you have to understand this inflation correlation, their Bank of Japan's outlook on economy, and then how will they position themselves. In this case, you need to know the following. They are satisfied with their GDP growth. They are slowly increasing the interest rates to fight inflation, which if you read the whole document, they blame part of the inflation on wages increasing in Japan. And their main goal is to have 1% interest rate, 1% interest rate to the middle of the fiscal year 2025. Now, CPI currently is around 3%. It is sticky and it is growing in the last possibly maybe 2 or 3 datas, but I would argue it isn't easy to say. I would argue it's more in the range-bound market, and just like in the USA, more on the sticky side, but with their market expectations to increase the interest rate in the future, CPI should fall down. Now, let's check out further. Their main export partner is the United States, which means they are tied to US dollar, of course, and they have low unemployment rate of 2.8%. Let's check out unemployment rate in Japan, currently around, let's use last 5 years of data, is around 2.5%, nothing specific. Then, if we want to look at balance of trade or imports versus exports, let's find imports, exports. That's called current account. So current account is, let me give you an example. We have a country that has 2 products. One of them is cars. The other one is dental services, like dental tourism. And foreigners pay for the cars and they come to your country for dental implants and they pay it. This is current account. Current account is the value of your exports, meaning physical commodities, physical exports like computers, cars, and services like tourism, right? And usually, what did we have with Japanese yen? We had it falling down. When your currency falls down, your imports, something you want to import in the country, becomes more expensive, while something you want to export outside is more cheap. So your exports that's called depreciation or devaluation of a country's currency. Your exports increase while your imports decrease. So in our case, if we had USD Japanese yen bullish uptrend, pretty strong for the year and a half, you could say or you could expect that their current account got better. And if you look at from where Japanese yen started its downtrend, their current account really did increase. and is now highest, I think, in the last 10 years. Yeah, even more. Highest in the last 10 years is their current account. So this devaluation of Japanese yen, if we want to analyze the economy even further, helped industries within this economy and pushed their revenues, which are exporting to the United States. On the other hand, for all the imports within the Japan, they became more expensive. As they became more expensive, these businesses had to pay more for these goods. And as these businesses had to pay more for these goods imported from USA or China or whichever other country, then they had higher costs. And with that higher costs, they increased the price in Japan. And that is one of the reasons also why inflation went up. Because they tried to push the prices of increased costs to actually Japanese citizens. So this is something Bank of Japan did not mention, but we did actually have part of the inflation was definitely caused by weakening of the Japanese yen. Usually when your currency loses value, you have threat of inflation, especially if you import a lot. So this Japan's current account is actually all the imports minus all the exports. And in this case, we had more exports. You see 3.8 billion of Japanese yen compared to the imports. In 2023, it was January, it was negative. So to sum it up, you had GDP, which their central bank is pleased with. You have CPI around 2-3%, which is higher in a lot of the underdeveloped countries. And now they are raising interest rates, telling you that it will be 1%, which if you combine it with all the other macroeconomic news around the world we know where inflation is falling down like Great Britain, tells you that you can see the divergence again in monetary policies. Bank of England reducing the interest rate and Bank of Japan increasing the interest rate, thus having lower carry trade value for us. Then we know that they are net exporters to the United States, that their labor market is pretty strong. Now, with all this data, we have to ask ourselves, okay, fiscal policy authorities, monetary policy authorities, we already know what their central bank is going to do and how they will act. As it is written here, their plans is to lift interest rate from 0.25 to 1% interest rates until value of the interest rate until the middle of 2025. Now, regarding fiscal policy, you know that fiscal policy is how countries spend taxes, collects and spends taxes, and redistributes taxation within the country. For example, police officers might not, their wages might not be taxed, while doctors could. So this is actually within fiscal policy tax redistribution, something called the tax base. This is one way fiscal policy acts. Another way is how do they finance itself? How does the country finance itself regarding spending? So regarding spending, we look at GDP data also. Let's find it. We look at their debt to GDP ratio. Why is this important? Because if we have debt to GDP ratio, if it is, let's say, if the government is having fiscal deficit, meaning government produces 100 and spends 125, this 25 difference has to be financed from somewhere, and it is usually financed by issuing bonds in the market, which investors buy, and then Bank of Japan, or sorry, government of Japan owns these investors to repay them for the bond market, the value of the bond plus the interest rate. So if we look at the last 5 years, usually the higher debt to GDP, the worse the economy is, because that means that your production is less of a yearly part of GDP, right? If you produce 150 and you owe 200, that means if you worked for the whole year and nobody got wage, nobody got paid, you would actually repay only part of your debt. In this case, in Japan, Bank of Japan is here also important because they are the main buyer of Japanese bonds. In this case, you could see that Japan's debt to GDP ratio was actually stable for the last 5 years, which is, I would argue, pretty important. If you have exponential growth of debt to GDP ratio, that usually leads to countries meltdown, political riots, economic riots, etc. So their debt to GDP ratio for the last few years is stable, which tells you that they are not conducting expanding fiscal deficit. Let's check it out. Maybe we can find it somewhere. If that is the case, government budget will be in negative, but this negative value will not increase significantly. Let's check it out. So you can see that their budget value is negative, which means they are having fiscal deficit, spending more than they earn, but it is not skyrocketing. This line, let's make it as a line. This line is not going down like this, okay? So their fiscal deficit at this point in time is stable. Now, so fiscal policy, I would argue, is acting responsibly. Monetary policy is acting also responsibly. So let's sum it up. We have GDP stagnant with expectation of growth, CPI more on the downside, ranging, but more on the downside, I would argue sticky. Exports or current account positive because Japanese yen lost a lot of its value. Labor market pretty strong. Fiscal policy conducting reasonably well. Monetary policy telling us what are their plans to have 1% interest rate until middle of 2025. And also they are telling us we need to watch that as well. That's why we always comment on US economy, looking at what the US economy is doing. So in the long run, if we have world where we expect US dollar to reduce the interest rate, Federal Reserve, and when we expect interest rate hikes by Bank of Japan, in the long run, Japanese yen should strengthen. In the short run, it is most likely gonna range. Now, why would it range? Because remember also another important point, Japanese yen is a safe haven currency. If Japanese yen is a safe haven currency, it means it usually grows strongly, appreciates strongly in recessionary environment. And currently we are not in a recessionary environment. We are in a business cycle environment where there is spending, expansion, growth of GDP, which is a risk-on environment, which translates itself to risk-on currencies like Euro, Great Britain, British Pound, right? Hungarian forint, etc. So in that case, in the short run, because of this business cycle movement, which is different from Japan's monetary policy, I expect that Japanese yen should actually, in the short run, move in a range-bound market. In the long run, I expect it to fall, and we will have a reversal of this trend. Now, regarding our business cycle environment, the important thing is that we are currently in an expansion, stage 3, stage 4, even we have expansions in commodities area. We still have present carry trade because we still have interest rate differential between Japanese yen and US dollar or euro or Great Britain. So we are still positive on the carry trade, having a positive swap. Now, regarding commitments of traders analysis, meaning positions of the biggest players, I could not find something conclusive that I would that would say to me, okay, we have reversal, strong reversal in the trend. Okay. So then on rotation graphs, I will not go too much into detail about that, but I do expect that in the middle run, we could see actually Japanese yen losing this value, and it already has happened. So our suggestions of looking to play shorts on Japanese yen actually turned out to be correct. Or the other thing you had to find is find your technical entry of GBP Japanese yen longs or Euro Japanese yen longs. They did play out. Regarding current client sentiment, 50-60% are on the net long and 50-60% are on the net short side, which is something I don't want to see whether entering into long or short position. I will not go too much into technical details. Maras can do it on his own style. Then, in conclusion, what I wrote. In the short to middle run, Japanese yen will range against euro and British pound, probably next 6 months. In the long run, Japanese yen will strengthen against euro and British pound, especially if we see divergent monetary policies, meaning if we see inflation falling within Eurozone and Great Britain and inflation still sticky in Japan. Of course, we are going to be wary of future economic data coming out. And ideal short would be if we have recession coming to us, right, as an opportunity, recession in the United States and around the world coming at the same time while Japanese yen sentiment is changing and divergent monetary policies around the world, then we'll definitely have even stronger Japanese yen bullish uptrend. So this was the analysis of Japan's economy, their monetary and fiscal policy, etc. Are there any questions? Maybe this was a little bit too much, huh?
Yeah, it's not, but it was interesting. Maybe I will probably watch it again.
Yeah.